All right, good morning, everyone. Thanks for being here. This is Brian Boyd. Welcome to the Boyd Wealth Management 2022 Economic Outlook. As you know, our plan was to host an in-person breakfast once again at Del Paso Country Club. Omicron thwarted our plans, of course. The health and safety of our guests, our team in Del Paso is our top priority, but all is not lost. Our special guest, Chris Shuba, and I are much better looking over webinar. So you're in luck today. Chris, are you there?
I'm here.
All right. You look great this morning.
Thanks so much. I really did put a lot of effort in today.
Well, we're excited to be here with you all today on our 14th consecutive year hosting this event. It's our favorite opportunity to connect with clients and friends and give our thoughts on the economy and markets and how that relates to your financial plans. Here are our disclosures. This is not a solicitation for investments. This is not investment advice, and past performance is never an indication of future returns. The webinar is being recorded, and you can submit questions via the Q&A tool at any time. Before I introduce Chris, I wanted to share some highlights from 2021. This is our very popular Asset Class Returns Quilt for 2022. In the next week or so, I'll be posting today's video on our website in the blog section, along with a link to download this. And of course, feel free to email us if you'd like a copy prior. The quilt shows the last 15 years of data with yearly performance of the 9 major asset classes, plus a hypothetical diversified portfolio. The best performer in any given year is at the top, and the worst performer in any given year is at the bottom. And then you can see the average annual return for each of the asset classes over that full period, along with the average risk with the riskiest asset class at the top. The quilt is always important to review because it's a reminder that the world is unpredictable. Instead of trying to focus on which asset class will perform the best in any given year, the question to ask is, am I investing in alignment with my goals? When do I want my money back, and how much capital will I need to reach my goal? Probably what stands out most on the quilt this year is, again, the dark blue large cap stocks, which represents the 500 largest companies in the U.S. The S&P 500 has now ended the year higher in 13 of these 15 years. In fact, over the last 3 years, the index has more than doubled, which is the highest 3-year return since the 97-99 period. You could see real estate was the top dog last year, delivering a 45% return after being the worst performing asset class in 2020. Impressively, a diversified portfolio delivered 13% return last year. That's essentially a 60% stock, 40% bonds. And then over the 15-year period, the diversified portfolio delivered the 4th highest return of all the asset classes with the 3rd lowest risk. Really just demonstrating over and over again the benefits and power of diversification and asset allocation. Bonds. Let's talk bonds. I think this is light blue, but this was the first negative return for the Barclays Aggregate Bond Index since 2013. And 2021 produced only the 4th negative return year since the inception of this bond index in 1976. As you can see, by the negative 1.5% return, a bear market in bonds is very different than a bear market in stocks. A bad year in bonds is essentially a bad day for stocks. One last thing on bonds. While the income from bonds is low, relative to history, the asset class still exhibits strong diversification benefits to stocks. 2021 was a relatively quiet year for risk. So you saw those exceptional returns across different asset classes. But this chart shows the maximum decline for the S&P 500 from a high in any given year going back to 1980. That intra-year drawdown is the red dot, and the gray bars represent the price-only return for that given year. So large drawdowns, drops in any given year, are pretty normal. In fact, the average over that period was 14%, while 32 of those 40 years were still positive. Last year's largest drawdown was 5.2%. And I think we're already there here in 2022. But to put this in context, the S&P was so strong last year that it reached a new all-time high 70 times, which is the most since 1995, and the second highest ever during a calendar year going back to 1929. I'm sure Chris will expand on this in his portion, but investors in 2022 will very likely have a lot more to digest. The Fed is rolling off its balance sheet, raising interest rates. The rate of growth in GDP and corporate earnings will normalize from these elevated post-pandemic levels. Then, of course, you've got inflation, the unpredictability of whatever the next COVID variant is, and probably a few other surprises no one is considering. Regardless, that's the benefit of having a well-defined plan and investment strategy. We are ready for a difficult year and will thrive in an exceptional one. In a bull market, there's always concerns about valuations being stretched, with the fear being a bubble and imminent crash. Stocks didn't just go up in 2021, though, because interest rates were low. Last year, S&P 500 companies delivered with record profits, growing their earnings per share by 72%. Earnings were so strong, in fact, that even with the S&P 500 increasing 28%, if you include dividends, the price earnings multiple, which is how much investors are willing to pay for a stock, were actually driven down throughout the year. So said another way, stocks actually grew into their lofty valuations from the end of 2020. What talk would be complete without ARK and crypto and some meme stocks? I'll get to some of these fun things. But while the general market was rising, not all stocks were treated the same. Stock picking is super tough, and high-flying growth stocks had a difficult year. Cathie Wood's famous ARK Innovation ETF would fall over 23% in 2021. As for inflation, this was perhaps the biggest story of the year. The cost of seemingly everything went up in 2021. Even the long beaten down commodity asset class was up 27%. By the end of the year, even the Fed had to ultimately back off their transitory argument and vowed to end quantitative easing here by March. Now the market is expecting at least 3 interest rate increases from the Fed, with the odds of a fourth growing daily. And in the last reading of the year from November, inflation reached its highest level in 20 years at 6.8%, well above the average of 2%. Just last week, the inflation number for December was released, and it rose further to 7%. While everything was seemingly more expensive in 2021, the cost for energy and used cars and trucks were the biggest outliers, up 30%. The silent killer, though, you all know this, was the cost of your morning cup of coffee, which increased by 76%. I don't think that has slowed the lines at Starbucks, though, to be honest with you. What's not showing up fully in the inflation numbers is the real cost of housing. Home prices continued their march higher, with the Case-Shiller U.S. Home Index increasing by almost 16% in 2021. As my good partner Ryan Triplett puts it, inflation affects people in different ways and is a very personal thing. Certainly, we all consume groceries, but we have vastly different driving habits and gas usage since the beginning of the pandemic. And if you bought a car before March of 2020, you're likely not part of the new used car inflation. If you bought a home pre-pandemic, you're benefiting from the price appreciation and the ability to refinance at much lower rates. Let's talk meme for a second. So 2021 sure was the year of free-flowing capital, right? And that found its way into highly speculative assets. And meme stocks were no different. I'm showing here GameStop and AMC, which ended the year more than 50% off of their highs. But these struggling companies turned in solid returns thanks to the Wall Street Bets Reddit gang. Crypto, Bitcoin increased 60% last year, while Ethereum increased 400%. At one point, Dogecoin, which was created as a farce, was up 12,000% before crashing down to earth, quote unquote, and finishing the year almost 3,000% higher. And before I wrap up my opening remarks, I wanted to give some quick updates on our firm. In the last year and a half, we added 2 incredibly talented people to our team. Chris's picture's here. He's part of it, but he's not what I'm talking about. Many of you have already interacted with Justin Steingraber. He is a chartered financial analyst and serves as our investment operations manager. In addition to assisting clients with their day-to-day needs, he's behind all those trade notifications you get from Schwab as he carries out our firm's trading and investment process. In his limited spare time, he has 3 daughters, all under the age of 9. Justin has been studying diligently and will sit for the Certified Financial Planner exam in March. And just last year, we added Jen O'Brien to our team as our investment operations associate. She supports our clients with account opening, money movement, and maintenance of their financial plans. She also ensures the accuracy of data across our platforms. She has a master's in business management and is very recently married. Congratulations, Jen. I'm confident you'll be interacting with her more in 2022. Our firm is incredibly strong thanks to your ongoing trust and faith in us to help you reach your financial goals. As you know, our mission is less about building the biggest firm and more about building the highest quality firm that delivers exceptional advice to extraordinary people. It is now my pleasure to introduce and welcome back Chris Shuba, founder and CEO of Helios Quantitative Research. He and his team are super cool quants, which essentially means they're very smart people that collect and analyze data, which advisors like us can use to make statistically relevant investment decisions. What we love about quantitative research is that it's only concerned with facts, leaving no room for emotions in the investment process. Helios provides economic market and portfolio construction research to advisory firms across the country, collectively managing over $30 billion in assets. Our investment team engaged Helios about 2 years ago to incorporate their data into our portfolio management process. Essentially, we're layering a quant strategy on top of our traditional asset allocation approach. The goal is to improve portfolio outcomes while adding a layer of risk management. Chris has been a chief investment officer for an asset management firm, as well as a senior quant analyst at Columbia Threadneedle. He holds a BS in business and law from the Opus School of Business at the University of St. Thomas. Chris, thanks for being here.
Well, thanks for having me, at least audio-wise, that's for sure. Can you guys hear me all right? Is the audio coming in good?
I can hear you great. So we'll just talk through a slide list today, or do you want to email me the slides and I can pop them up after you begin?
You know what? Just in terms of ease of use, that would have been smart to do. I'll just talk through them a little bit here, but I will email over to you, right now what I was going to put up there. But I thought what we'd do today is more or less, talk through why we're here and what it is that we are tasked with kind of sorting through in 2022. So that deck is in your inbox. And what I want to start off with is, where did we actually come from to get to today, right? So what are the real world implications of the COVID pandemic, and how are we going to deal with that in 2022? So first and foremost, if you go back to 2008 and you look at the S&P 500, like Brian was mentioning, we've only had one negative year since 2008, and that was 2018. I don't know if you guys remember the big crash down about, almost 20% right before Christmas in 2018. And then the bottom was the day after Christmas Day. And then we, of course, went on to make 31% in 2019, 18% in 2020, and then 29% when you add back dividends in terms of the last year alone. So we've been on this ridiculous run, and it isn't just a function of COVID, right? It's a function of the hangover effect that we've had since 2008. And the question is, well, what is that hangover effect? Well, the hangover effect is monetary policy, as we have gone through time, trying to manage various economic calamities that have hit us. The tech bubble in 2000, the global financial crisis in 2008, and then, of course, the COVID crisis in 2020. And each and every time we've gone into that scenario, we've been rewarded by stimulating the economy. So the Fed has a playbook, and that playbook is generally related around two activities to stimulate the economy. The first is by buying bonds. Now, most people don't think about this. Most people don't think about bond buying as a critical part of saving a country or an economy from a crisis, but ultimately credit, or bonds as an example, is the grease that makes the world go round. Why 2008 was so bad was because credit seized up. Nobody wanted to lend anyone any money, right? And that's what made 2008 so bad globally. So what the Fed does right away is it jumps in and starts buying up bonds. Now, it does this to calm the bond market, so that people don't just get scared and sell because they think that the prices are going to fall out of the bottom of the credit markets. So by buying bonds or being a buyer of last resort, it creates calm. And it also creates less risk. So interest rates naturally come down, right, when the Fed is in there buying. And we saw that in 2000, 2008, and we saw that here in 2020. At the same time, what the Fed will do is manually lower interest rates, because the Fed controls very, very short-term interest rates, such as overnight lending, whereas the bond market controls all the other interest rates, such as your 30-year mortgage or a 10-year treasury, right? So by collectively lowering the risk of the bond market by being a buyer, that brings down interest rates across what we call the curve. And then at the same time, we have the Fed manually lowering interest rates. What that does is creates less risk for businesses to invest in growth. And it also has the effect of, in many ways, increasing the amount of money that's out there, which we'll get to in a second. So the Fed didn't really do anything out of the ordinary than what it normally does during a recessionary potential environment than what it did in 2020. So that's the first level setting that I always like to make with this. Now, what added fuel to the fire here was an unprecedented amount of stimulus programs that were enacted by Congress, which is different than the Fed. And the net effect that we're dealing with here between what the Fed has done and what Congress has done is an increase in the M2 money supply of about 39%. So let's call it 40% for round numbers. In other words, there's 40% more money out there than there was previously, right? And that has led to a large number of things happening, right? Number one is the combined effect of a lot more money out there, plus the shutdowns of COVID, has created this shift in buying habits. And you probably noticed this on yourself, right? You probably noticed that you're paying a lot less in experiences or services, and you're probably buying more goods, right? Maybe you bought a new car. Maybe you bought a new TV or a computer. Maybe you started, improving your house or your yard or whatnot. We are buying a lot more goods right now than we did pre-COVID because people aren't traveling as much, right? There are some travel, right? But there's not as much. A lot of things are still closed. People are saying, no, I'm not going to go to Disneyland because it's just not the same. I want it to be open and the same before COVID, and so they're pulling back onto that buying. Well, that has created a lot of demand for physical goods. Well, very quickly, we blew through all the physical goods that were out there, right? The inventories that were there. And these factories said, okay, we need to ramp up production and restock shelves. But lo and behold, a lot of those initial portions of the supply chain, they're not back to work yet, right? These emerging markets are being hammered by COVID. They don't have access to vaccines. They don't have access to treatments. So they're basically just shut down. And China's been one of those, right? Where they will just lock it all down and not produce anything because they don't have the same resources that a lot of developed nations do. So in the very, very beginning of our supply chain, such as raw materials, stops happening, then it just ripples through the economy. And that's exactly what we've seen, right? So as inventories became more scarce, prices go up because that's supply and demand, and we get inflation, right? Now, inflation is the most powerful force of all things. It's like water. It just slowly erodes everything, right? Same exact thing with inflation. So that's why there's a lot of concern about it. In fact, there's only two things the Fed cares about: inflation and jobs. Why? Well, oversimplifying it, but jobs creates taxes, and taxes pay the monthly payment on all of our debt as a nation. But ultimately, the principal, if you will, gets paid by inflation. We still owe debt from the Civil War, but it's like $500 grand. No one cares, right? We inflated our way out of how much that money actually matters. So inflation is a tool, right? You just can't let it get away from you, right? And for years and years and years, inflation had been the canary in the coal mine. If the inflation number gets too high, that means the economy is doing too well. There's too much demand out there. And we need to do things such as raise interest rates to slow the economy down, to stem the buying, to allow supply chain and manufacturing and everyone just to catch up, take a breather, restock shelves, replenish coffers, in terms of wealth, and then go ahead and move the economy up forward again. And so it's just a well-orchestrated dance that everyone tries to participate in. So that's where we're at the moment, right? So we're at the moment here. We've got this stimulus that's come in. We've got this normal Fed playbook that comes into economic problems. And we end up with the supply chain and inflation problems that are a result of these two things. The question is, who's to blame? And realistically, I love going after Congress, and I love going after the Fed, and I like kind of beating them up a little bit. But at the end of the day, there was no possible way for them to get this answer right. They had two choices back then: either overstimulate the economy or understimulate it. And I think if everyone kind of weighed both opportunities, most everyone would pick, well, let's overstimulate the economy and deal with it. And that's exactly where we're at the moment, right? So now you have all this money washing around. You have people wanting to buy all these goods, right? And corporate profits, as Brian mentioned earlier, are all-time highs. Man, everyone's making money because there's so much extra money that's out there. Now, we run into this problem of, fine, we know where it came from. We're okay with it, as much okay with it as we possibly can be. What does this mean? What is in store for us as we make our way from this highly stimulated, way bigger amount of money out there? What are we going to do? What are the steps that we have to expect and then therefore kind of make sense of emotionally as we go through this unwinding of what we did in 2020? And let me walk it out for you here, because it's going to be pretty intuitive, but we just need to be prepared for the fact that this does equal volatility in the stock market, as we've already seen, okay? So number one, the Fed says, okay, I have these tools. I have these superpowers that I can use when the economics start to get bad. And that is, number one is interest rates, right? That's my gas pedal or brake pedal on the economy. And when interest rates are low, that's stepping on the gas. When interest rates are up, that's hitting the brake pedal. And right now, interest rates on the short term are zero. So they need to go up, right? Why? Number one, because we have inflation, and that's going to hopefully bring down inflation by raising interest rates and slowing the economy. But secondarily is if we get into another economic crisis and rates are already at zero, I don't have a superpower, right? The Fed doesn't have a superpower to use. So they have to get rates up. So the first step to seeing what the natural state of interest rates are is they have to stop buying bonds. So a number of months ago, the Fed stopped buying bonds, and they called this tapering. So you probably were on the news and you heard this term and you're like, what the heck does tapering mean? It means they're going to slowly taper off the amount of bonds they're buying, because the bond market really doesn't need the support at this stage, right? I mean, the market just made 25%. I mean, how bad can it be, right? So the Fed says, okay, we're going to slowly stop buying. And therefore, if the Fed is no longer a buyer in the bond market, well, now suddenly the bond market is a little bit riskier. And so rates will naturally rise, generally longer term rates. So 5-year debt, 10-year debt, up to mortgages at 30-year debt, right? And so those interest rates will slowly climb. And we've seen that. We saw it happen a little bit in February, March, where we almost got a correction on the S&P. We got one on the NASDAQ back in February, March. But that was a kind of a fear-based thing as interest rates rose a little bit and then came back down. Well, now the Fed is actually physically doing things to move interest rates. And now we're seeing interest rates back up on the 10-year as an example around 1.8. And we are seeing that fear or that trepidation in the bond market creating losses, right? So that's all justified, right? As interest rates go up, bond values go down. The question is, and we'll answer this in a minute, why should I even own bonds? But that's kind of one of the punchlines here, so I'll save it. But at the end of the day, we have these rates that are going up because the bond market is now a little bit riskier because the Fed is backing away from the punch bowl, if you will. That's number one. The second thing the Fed's going to do is they're going to manually raise those short-term interest rates like I talked about earlier. So once the natural state of interest rates is known by the Fed ending its tapering, they're going to then say, okay, we need to raise short-term interest rates by, a quarter point. So 0.25%, or what we would say 25 basis points. And that will then be the first step. And we expect them to do this probably 3 times throughout the course of the year. So right now we're at 0 on the short-term side. We expect to be right around 75 or 0.75 on the short-term side by the end of the year. Now, some models are pricing in 4 interest rate hikes throughout the course of the year, bringing us up to a full 1%. I don't think that's going to be the case. I think that it would be very rare to see a rate hike during a midterm election season or any election season because of just what it does to the markets from time to time. So I have a feeling politics is going to win on that end because that's what's historically happened. And I'll get to what my major concerns are in the future here as we wrap this up as well. So that's what the Fed is doing. They are going to raise rates by ending the tapering and by physically or manually moving up short-term interest rates, right? But that's not really solving one of the big problems, and that is this idea of the M2 money supply. So as mentioned, there's just a lot more money out there than there was previously, and that has natural ramifications, right? It increases the problem related to inflation. It also allows people to rethink their work effort, right? So we're about, let's just call it 3 to 4 million jobs short of where we were previously, right? So you've all noticed when you go to the restaurant or you go to any other place where there's a physically demanding type of a service, whether it's warehousing, whether it's driving a truck, whether it's a delivery service, whether it's, food service. These physically demanding, typically low-paying jobs don't have enough workers right now. And this M2 money supply problem is really the root cause of it. What I mean by that is that when COVID kind of shut everything down, a lot of these folks lost their jobs, right? And they had to figure out life without that job. And for a while, we all looked around and we blamed, well, unemployment is so high, unemployment insurance and payouts are so high that actually people were making more money staying at home than they were going to some of these jobs. And in some cases, that was absolutely true, right? In some cases, it wasn't as much money, but of course, there was, the opportunity to start your own business, right, and get paid unemployment. And a lot of folks did that. When you look at the percentages, it's only around 3 or 4%. So we're down about 3 to 4% of our workforce. And when you look at all the major life decisions and adjustments and exposure, if you will, to a different lifestyle that was forced upon people, whether or not you want to stay home and homeschool your kids, whether or not you want to start your own business, whether or not you're just okay going down to a single income and not working at that fast food restaurant, it's very reasonable to see that 3 to 4% of people would say, hey, I kind of like my life post-COVID better than I liked my life before COVID, and I'm going to keep that life, right? It's not an unreasonable percentage. And so what we're seeing right now is not an effect of, and like I said, I'm the first guy that's going to jump in and try and, bash on Congress a little bit. But at the end of the day, we're seeing natural and expected percentages of people just rethinking their life structure. We're not seeing people that are necessarily incentivized to stay home. And I don't think this is going to end anytime soon until we actually have some form of an economic hardship. Until we start to see unemployment rising, we start to see mass layoffs. What's going to kind of end this cycle of low work activity and these more service or physically demanding oriented jobs is going to be the economic cycle itself. It's not going to be the end of a specific government program that's going to simply fix all of that. Okay. Same thing with potentially supply chain issues, which again we'll talk about here in a second. So this M2 money supply, there will likely be some activity by the Fed to try and suck in more of this excess wealth. And the way they'll likely do it is by restricting the banking system. So they'll have banks hold more in reserves or reduce their lending capacity, because there's essentially, for every dollar that gets created, there's a multiplier effect to it. So if I have a dollar and I make it available in the world and I get that dollar and I put it in the bank, well, now I have a dollar in the bank. But the bank can then go out and lend, let's say 75 cents of that dollar. Well, now there's magically $1.75 out there from the initial dollar. Someone else gets that 75 cents, and then they deposit that in the bank, and then the bank can lend 50 cents of that, and the money just multiplies out. And so the Fed controls what banks can do in that regard, and that effect of multiplying how money works and the velocity of money is something that will come under scrutiny here in 2022, but I do not believe, from what we've seen, the Fed has a strict game plan on how to do that. So there's a lot of these internal machinations all going on between the Fed and Congress and the economy. And a lot of times we use analogies like gas pedal, brake pedal. The cars are very nimble. This is more like gas pedal, brake pedal on a cruise ship, right? If you want to stop a cruise ship, you're starting to stop 20 miles out of shore, right? And even then, you need some help docking the thing, right? It's the exact same way with the economy, a much easier analogy to think about just how little movements are made 20 miles before the movement actually matters. Same exact thing with the economy. The Fed's making its moves now with interest rates, and it's not going to know exactly the effect for 6 months to a year. And that makes it incredibly difficult, but hey, we all have things we have to do are difficult in life, right? So that's where the Fed is. Now, what does this mean? Like, where are we going with this? Well, the first thing is we haven't had a correction in the market since March of 2020. And we normally get about 1.5 corrections a year. A correction is at least a 10% loss in the marketplace, is at least a 10% loss in the marketplace from its all-time high, okay? Now, we had one in the NASDAQ back in February, March of last year, but we didn't get one on the S&P. We almost did, but we didn't. So we're due for some volatility. And if you really think about it, these conditions are pretty ripe for some volatility, as we've seen over the last number of days. And so what I would really have you focus on is making sure that with your advisor, you are really good with your risk tolerance, that you're knowing, Brian and his team, I'm sure everyone's exactly set up the way they need to be, but that's where your comfort level is going to come from during periods that are correction, short-term volatility around acute problems that tend to come and go. And you don't want to get too cute and fancy with how you try to, what do you own and what do you not own, and how do you risk and how do you de-risk. You don't want to get super cute there because you can get whipsawed pretty bad. But you simply want to be able to move through these volatile periods of time knowing that they're expected and they're all part of the plan. And that's really what we're seeing here. So the best case scenario is that we're going to go through this period of time with some choppiness. And we're going to have the first rate hike. The world doesn't panic. We move through it, and we just kind of get into this normal flow of knowing the rates are going to go up, knowing that certain companies and certain sectors are going to get hit by that, but the corporate earnings continue to do as expected. That's the best case scenario. And so do I see another 25% in the marketplace this year? I don't, right? I would just put numbers like that out of your head. I mean, the fact that we've gone 31, 18, and then 29 is phenomenal over the last 3 years, right? 19, 20, and 21. We are going to have to normalize at some point, right? So just understand that and feel that. So number one, your risk tolerance is going to be important. What's the worst case scenario? The worst case scenario is all around inflation. So if we look at the expectations, and Brian, I know that when I sent over those slides, there's the fourth slide is one that might help visualize this comment. But there are highs and lows, and then there's the median level of expected inflation rates as we go into 2022, geez. And the key thing to see here is the idea that inflation is supposed to crest in this past Q4 period. Right now, we've already got the December data, and that was high, 7% on an annualized basis, right? If January is a little higher, it wouldn't surprise me. But February is definitely expected to be lower on an annualized basis. And we should see those numbers in March. And if you're asking me, just my opinion on when we're going to see kind of that, come to reckoning type of a moment in the marketplace, that number we get in March showing February is going to be one of those moments. And the reason that is that if February is demonstrably lower than January, and hopefully January was lower than December, now we start to see this data cresting over, and we're coming down from the inflation problem. What that probably means is that the tapering effect is working, right? That we're starting to see people pull back on demand, and this is a function of numbers as well, right? Because we're all looking at, relative to last year. That's an important date. If that isn't happening, if February is higher or the same as January, and January is the same or higher than December, and we're really not seeing inflation crest like you would see here in this chart that I showed you, now you're going to see the Fed be in a pickle. And that pickle is, okay, do we act heavy-handedly and slap down inflation as best we can at the risk of stalling the economy? Or do we play this more soft and just hope that inflation comes down? And no one knows what they're going to do, right? So if they try to slap down inflation, what they would do is raise interest rates faster and say, okay, instead of raising at 25 basis points, we're going to raise at 50 basis points. A big leap in interest rates at the flip of a switch. And there's an old joke out there that's not funny. No one's ever laughed at it. But the joke is, bull markets don't die of old age. They're murdered by the Fed. The Fed has a consistent, history, if you will, of trying to stop the cruise ship and running into the dock, right? It's just really, really hard to do. And that's the joke. So my worst case scenario is we have a Fed that gets in there because of runaway inflation that they don't think they can control, and they make the call of, I would rather deal with a struggling economy and stimulate it than a runaway inflation economy that I can't control, and smacking it down. In that case, like I said, this is stopping a cruise ship. This is moving a cruise ship. So even though they might do that in maybe March, then we end up with ramifications later on down the year or the next year. And that's why we run data all day long every day, is to kind of make sense of this opportunity set. So best case scenario, the Fed follows its game plan, regardless of what inflation does, and the markets just kind of motor along, and we get some volatility, probably get a correction at some point, and we just kind of make our way through this transitionary period in the economic cycle, moving away from stimulus back into normalization. The worst case scenario is that the Fed sees inflation as something that it needs to smack down and makes big changes in interest rate policy, and we have ramifications from that down the road that might stall out the economy entirely by people not willing to take on risk. And that's a problem. So we're going to know a lot here as we get towards the end of Q1. And again, it's just about managing our way through it, because there's really nothing. It's a slow moving steamroller, but we all see it coming, right? And we're just going to have to kind of see which direction it starts to turn. But the nature of it is that if you're comfortable in your risk tolerance, we're not seeing this data yet as being systemic or what we call sustained and deep volatility. And this is kind of where I want to make a point, and then I'll get into the bonds real quick and then answer some questions. But do not be afraid of short-term volatility. It's very natural and it goes by. An example I've used many times is if you lost 90% of the value of your portfolio for 1 second, did it matter? And the answer is, yeah, it mattered. It was a really stressful 1 second. But in terms of achieving your long-run financial goals or maintaining what you have already in retirement, that 1 second was scary, but it didn't matter because time is the ultimate problem. And so with us, or the way we tend to think about things, I don't care about short-term volatility because it typically comes and it goes. And that's why, you have your blend of stocks and bonds as an example, is so that you're comfortable through these periods of volatility. What we're mostly concerned about and where we want to make overt potential or portfolio moves is when the volatility has the potential to be sustained, that it could be around for a year, 2 years, 3 years, 5 years. Like it took in 2008, it took 5 years for the markets to get back to zero, right? Those are obviously times you want to be very focused on risk management. Whereas short-term volatility, oftentimes it's so fast and it recovers so quickly that you almost have to ride through them. And so right now, the data is showing us that the volatility we're expecting is that short-term variety. But like I said, if the data changes, obviously we fluctuate with that as a quantitative shop. So setting your expectations for 2022, we do expect it to be a positive year in the markets, but we do expect it to be bumpy, especially here in the first part. And we could see a correction for sure. So simply just kind of hang on to your hats a little bit. We'll make our way through it overall as a so what type of moment here. I know I'm running a little bit past time, but real quick on the bonds. Don't be afraid of bonds. One of the things that retail investors tend to make a big mistake on is thinking that every single part of their portfolio should be making them money at all times. And that's really not the role of bonds. Bonds are in this environment are designed to do two things. Number one is serve as a ballast against volatility. As Brian pointed out earlier in the call, a bad year in bonds is like a bad day in stocks, right? And so they're there to be a store of wealth, preserve that wealth, generate some income, and create a part of the portfolio that simply isn't as volatile, especially when you get into unknown times. And bonds, even though they lost money last year, do a really good job of what they're designed to do. And they certainly did a decent job in 2020 as well, right? The second thing bonds need to do is become a hedge against inflation, right? So because they pay interest, right, it's designed around this concept of being more valuable than cash. And even though bonds lost a little bit last year, well, theoretically, if you look at the December's numbers, cash lost 7% last year. So would you rather lose 1 or 2% or lose 7, right? And the answer is, well, I'd rather lose 1 or 2%. And that's exactly what bonds did. So bonds have done their job. It's not pretty, it's not sexy, it's not fun, it's not like betting on Apple, but it is a function. It is an important part of a portfolio. And there's really nothing to replace it with. As mentioned, cash isn't an option. But if you look at all the different alternatives that are out there, whether it's real estate or commodities or crypto or anything like that, you're really not talking about a bond replacement. You're talking about a stock replacement, because those are all very volatile asset classes that bonds simply aren't that volatile. And that's part of the reason why you own bonds is to mitigate that volatility. So one of the things that I would just kind of do, and not everyone is this way. Some people, love the bond part of their portfolio. Other people are very frustrated by it. And my thought process to you is that, if bonds are super frustrating for you, make sure you meet with your advisor. Maybe own a little bit less bonds, right? Just to make yourself feel better. But overall, just pay attention to the design of the totality of the portfolio and what it's designed to do in terms of risk and return to get you where you're trying to go to. And focus more on the totality of the portfolio than individual increments that may struggle in certain periods of time. It's an incredibly important thing. We see, the greatest losses that we see in retail portfolio performance comes down to the emotional side of things and the decisions that feel good in the moment, but end up not, creating the most advantageous growth environment going forward. And so something just to think through. But yes, bonds do have value. Yes, they're going to have a problem this year. There's no doubt about it. But relative to other stable assets that you could own, they still do a good job of doing what they do. And that's an important piece. Now, if stocks really struggle this year for any unknown number of reasons, even though interest rates might be going up, bonds still might be more valuable than stocks. And again, that's something that is important when we talk about the stability piece. Last note, Brian, before I turn it over to you, I'm getting a lot of questions on real estate. Where is that? Is that a bubble? And the answer is we're not seeing bubble type data. We see nothing like what was 2008. 2008 was easy access to money with very low lending standards. And then the support of that by, the derivatives market and how you could, collateralize a lot of debt and people would actually buy it. Those markets are very different than they were. It'd be very, very hard to even repeat that sort of thing due to regulation. But that's really not what we're facing here. What we're facing is a basic supply and demand problem here in real estate. We need between, call it 4 million new homes to be built every year just to keep up with normal demand, right? So, burn downs and other natural disasters, remodels, and then population growth, right? We haven't built 4 million homes since 2006. Last year may have been the year that we actually built 4 million homes, right? So we've chronically underbuilt homes, period. Now you have this flood of people leaving dense urban areas, going to more desirable locations where there's just scarce housing anyway because there wasn't as much demand, and now there's double the demand. And so this isn't going to change for a while. The only thing I can certainly say would change that is if suddenly there was a snapback where some highly respected publication came out and said people are only half as productive working from home, and all these companies start bringing people back into the office again, and now you have this reverse flow. But I think that's a far cry at this stage. And we're just simply going to have to get used to the fact that this has been a long run real estate problem in the making. And this type of inflation in the housing market is going to stay around for a while. That's very different than the oil problem, which I know a lot of people are asking about that as a bubble. And the oil problem is a geopolitical problem as much as it is a supply chain problem. And there's simply not enough tankers, truckers, et cetera, right now to keep up. And so we have very, very expensive oil. Will that come back down? It will, right, at some point, due to, again, the geopolitical nature of it, as well as the fact that supply chain will eventually right-size itself. But it might take some economic hardship to right-size that supply chain. But it also goes without saying that we have to defeat COVID, or at least have global therapies in place so that if people get COVID, it's treatable, and that, these businesses can reopen, these mines can reopen, these shipping facilities can reopen, where it's people working long hours in close quarters, which of course is a breeding ground for COVID. So I know I went a little bit past my time, Brian, my apologies. Tried to stuff in way too much stuff. But anyway, I'll turn it over to you.
No, it was awesome. Thank you. What's the old saying in oil? Nothing cures high prices better than high prices, right? So the higher that goes, the less people drive, modify behavior. So we'll see how that story plays out. I just wanted to remind you that you can submit a question via the Q&A box. And we do have a question, and it says, what about ETFs? And so maybe you can elaborate on that.
Sure.
Well, on what our participant wants to know about ETFs. Maybe they can add anything specific, but I guess maybe just a quick backstory on your opinion, right? So traditionally there were, call it 3 ways to own stocks or bonds, right? Go actually buy the physical security, was option 1. Option 2 was go hire a money manager to go buy them for you and try to outperform the market in a mutual fund wrapper. And then option 3, which is maybe only, still 20 years old, still a relatively new concept, an exchange traded fund, which you own stocks or bonds in a wrapper that in most cases just tries to mirror an index. Maybe you could just talk about ETFs, kind of what you're seeing out there.
Sure. So to double down on that, you nailed it. There's 3 different ways to own securities. One is you can own the physical security itself. You can say, I own a share of Apple. The other way, it's been around forever, is a mutual fund where you don't actually own shares of an individual stock. You own shares in the mutual fund company, right? So as the mutual fund company grows in value due to it owning individual stocks, you then see the appreciation of the mutual fund company, and therefore your share of that mutual fund company grows as well. So in the 2 kind of quote unquote older ways, you either own the share of stock outright on your own, or you own a share of a company that then owns the stocks. That's the mutual fund. An ETF is kind of the in-between. An ETF says, look, you are buying a ticker, you are buying a company, so to speak, but you have direct ownership in these fractional shares that the ETF owns. So it's simply just the in-between or the hybrid between a mutual fund or direct share ownership. And ETFs have been wildly popular. They've brought down costs substantially. They've created more transparency. It's just the evolution of the mutual fund world, and it simply happens to be called the ETF. So I'm a big fan of them. I own a lot of them myself. But there are still some really good mutual funds out there as well. So it's nice that there's a lot of variety that's out there. Some strategies, you can only get in an ETF. Some strategies you can only get in a mutual fund based upon just what's most effective. But by and large, there's a lot of interchange between them. So if you're really comfortable with an ETF versus a mutual fund, you can have it, or vice versa. So that's a generic answer, I guess. But
it was great. It was great. Low cost, low taxes, and exposure to an asset class. We still use some mutual funds in a couple of spots where there's an edge, but ETFs are definitely taking over for those reasons that you outlined, and makes a ton of sense. We have another question. How do you think wildfire risk will affect new home building in the urban-rural interface? And I think you're probably more keen than any economist we've had, because you live in this area, and I believe you live kind of in that rural, urban-rural. But
yeah,
any thoughts on this? I guess that kind of ties into the climate and California wildfire risk. How's that going to affect housing?
Yeah, so to your point, it's really weird that we're down the street from you guys, even though we do business across the nation. So I'm out in Loomis, so I'm standing right now. We back up against Lake Folsom here, so the entire woodland SRA or state reclamation area kind of comes through the backyard here. So we're at risk as a house. I'll answer the question in terms of the larger movement that we're seeing that also happens to deal with fire. So the larger movement is around energy efficiency. So you have, a whole industry in passive housings that kind of self-insulate. You have a real focus on building materials and standards and what code is. And what you're simply seeing is this movement towards more higher quality, fire retardant, denser, energy efficient materials across the board. But that brings up the cost of housing. Right. And we're getting better at it from a technology perspective, but you're not really going to see, in my opinion, a lot of homes that are not built in beautiful areas that might be wooded. You're simply going to see construction methods and fire defense systems get more effective. And some of that by code and some of that by design. So, there's a story that went back. It wasn't last summer, but it was the summer before, the wildfires. And there was this neighborhood that was completely torched to the ground. And there was this one pristine house sitting there that was built by an architect that specifically designed it to be fire retardant. And there wasn't a scratch on the thing. And so you'll see that being more of the way that code and building materials goes. Think of this like the way code and building materials was 50 years ago, as earthquakes were a big problem in California, and everything that was done there, you're going to see the exact same thing. It's already happening. You're going to see more of it with the wildfire piece.
Perfect. It's almost like, ultimately becomes a decision about solar, right? When you put solar on your house, you make this big upfront investment, and then you save money over many, many years. With building, maybe you put in these fire retardant materials that cost you more upfront, and then your insurance is less, forever and ever. So I'd be curious to see how that works out.
Well, in reality, you're also seeing a lot of people struggle to get insurance, period. And
terrible.
That's also part of the equation. Yeah, you can build that house out there, but you better build it this way if you want to get insured. And that's part of what's driving the code change as well.
Yeah, so many of our clients are facing that right now.
Mm-hmm.
One last question, and then we'll wrap up. History doesn't repeat itself perfectly, but it does rhyme, right? And so the last Fed tightening cycle started in 2016, and I know you and your team have done a ton of backward kind of analysis on that period. But if I remember correctly, maybe it was January of 2016, we were kind of in the exact same spot as we are today. And I think the market maybe had, 3 weeks or a month of kind of nasty movement, but then kind of took off for 2 years, right? Until 2018, which was the last down year for equities. Can you expand on that? Is that kind of, it was short term last time and, making no predictions about the future?
Yeah, I mean, that's a good question. And if you realistically, this idea of tightening goes back even further back into 2013 and the idea of what we call the taper tantrum. And so the net effect of that was pretty interesting. The markets finished much higher because we had that tapering occur in the middle of the year. The first month of the taper tantrum was a bit of a pain in the butt, right? It was a steep down, and then it was a steep upward. But we really started panicking about it a couple months before. So markets meandered downward, had some very volatile days leading up to the actual tapering, and then was slammed down once the tapering was noticed. Rocket shift back up over the course of a month or so, and we finished the year out real high, or much higher. So I think that we've seen a little bit more less fear in the marketplace because of tapering in and of itself. I mean, obviously we've already begun tapering and we set new highs in the middle of tapering. So the same amount of fear and trepidation isn't there than it was back in that time period. But the same problems existed for bonds. Bonds did not do well that year as interest rate rose. Obviously bonds didn't. And so that's the same expectations here. So that's where we're looking at it, is that tapering, as funny as this sounds, is a good thing. It means the economy is doing too well. It means that the Fed doesn't need the help anymore. And so the trick is to taper at a rate and raise interest rates at a rate that can be handled by a good economy, right? And that's the delicate balance that they're trying to go here. So it's not like it's all bad news. There's plenty of good news in the economy. It's just that we have to balance that with, of course, this idea there's some bad news. So I would expect short-term volatility, not necessarily around tapering, but especially around the first rate hikes. So again, we're just expect that it's going to be rocky road here, at least for the first half of the year. There'll be some weeks that'll be nice and comfortable, but we're going to have some scary days. If we correct, it's totally expected at this stage. So kind of let it be as it is. But that also presents a buying opportunity. You mentioned earlier on, when you look at fundamental analytics, such as the various ratios, such as PE, the combination of prices coming down but earnings going up has created a nice, statistically relevant buying opportunity for people that can handle risk. And so, like I said, there's a lot of good that's going on here, but I would set the expectations, just looking back at 2013 through really 2017 is, expect some short-term volatility in stocks, but that barring any other outside news, there's an opportunity for growth. But yeah, you're just going to have to, kind of close your eyes and just kind of like shrug at the bond part of your portfolio and say, yeah, it's there for a reason, but that reason is not to look good on paper, and so it's just going to have to be that way for a short while. So.
Yep, that's right. Mm-hmm. And it's funny, we talk about, earnings per share being up 72%, last year. And, this year's projected to be no slouch, right? 8%, which seems ridiculous compared to a 72%. But, to your point, the economy is still really strong, even with the Fed tapering, and that's why they're going to taper, right? Mm-hmm. Mm-hmm. So we'll wrap up here. I think the key point from both Chris and I is more volatility in 2022. Last year was a really nice year. Just turn off the TV. Don't even look at your portfolio. Super comfortable. This year, I would recommend more of the same. Just know that we expect a lot more and deeper drawdowns. And then a good reminder from Chris, I heard, and we agree, it's always a great time to review your risk tolerance. Especially with our clients, we're in communication all the time, but you want to make sure that your portfolio is aligned with your goals, your risk tolerance, and your time horizon before the next bout of volatility, right? So if anybody wants to have a follow-up call, let us know. But thank you to everybody, and to you, Chris, for taking the time to be with us today. Can't wait to be with all of you again, live and in person. We're going to shoot for 2023, breakfast, And on behalf of our entire team at BWM, I wish you all the best in 2022.